The Federal Open Market Committee announced an outsized 50 basis point cut after its September meeting. Fed Chair Jay Powell characterized the move as a strong start to the process of, as he put it, recalibrating the stance of monetary policy. While we were surprised by the front-loaded nature of the process, we continue to expect that, based on our views on the economic outlook, the Fed is likely to proceed carefully from here. Let's take a closer look. Powell characterized the outsized rate cut as a sign of confidence that inflation is coming down sustainably to the committee's 2% target. He also noted that the labor market was in solid condition and that the rate cut was intended to keep it there. He returned to this point several times, perhaps to counter the interpretation that the larger cut indicated heightened concerns about the overall health of the U.S. economy. But we couldn't help notice that he also mentioned risk management as a factor behind the outsized cut. And in this regard, he reiterated that while the risks to achieving the inflation target had decreased, the risks related to the unemployment rate had increased. Powell cautioned against expectations of additional 50 basis point cuts down the road. He noted that the FOMC would go carefully from here, making decisions on a meeting-by-meeting basis. On several occasions, he pointed to the Summary of Economic Projections, SEP, where the median policymaker forecast painted a very gradual pace of rate cuts going forward, the equivalent of only 2 25 basis point cuts for the rest of this year, and an even slower pace of cuts next year, the equivalent of 25 basis points at every other FOMC meeting. Our views on U.S. monetary policy are always shaped by our take on the U.S. economy. We continue to anticipate a soft landing scenario, where inflation glides down to 2%, helped by a deceleration in economic growth next year to a little below its potential rate. This view is less optimistic than the median FOMC projection, which suggests the economy will grow at close to its potential rate year after year. As a result, we expect the FOMC to cut rates next year a little faster than implied by the median SEP projection. Looking ahead, we will keep a close watch on inflation data, but we will also be paying attention to any signs of deterioration in the labor market.